Hello and welcome back to Dukascopy TV. You've joined us for another edition of Hollenbeck Unleashed. Dr Frank is in the studio once again to talk the IMF and Greece. Dr Frank, thank you very much for joining me.
Hello.
Now, first of all, let's start with a quote. This is from Christine Lagarde. She's the Managing Director of the International Monetary Fund. And she says, I am always trying to be constructive, but I am driven by two objectives: to build and to approve a programme for Greece that is sold, that is convincing today, and that will be sustainable tomorrow. That is rooted in reality and not in wishful thinking. So, Dr Frank, we've got a meeting later on today between EU members as well as the IMF to talk about Greece. What's your take on this?
Well, as she said, it has to be rooted in reality. The IMF has determined that even under optimistic scenarios, Greece will have a unsustainable level of debt, and that ultimately Greece will have to go bankrupt and will have to reduce its debt by 100 billion euros. Now, the question is who is going to take the haircut on this debt? It's highly unlikely that the ECB will accept a haircut, because that would mean that they've monetized the debt, and that goes against their mandate. It's highly unlikely that the IMF is going to take much of a hit, nor the private creditors who've already taken a hit of 75% on the nominal value of the debt. So it's very likely that it's going to be on the amount that's been lent by the ESFS and the ESM. Well, what does that imply? That implies that the guarantees that were given by the EU countries now become real money, which implies that Italy, for example, will have to cough up maybe an additional 20 billion euros, and Spain may have to cough up an additional 15 billion euros. So if we consider that Greece still has a probability that it will go bankrupt in the short term, then Greece can still lead to a collapse of the system, especially if Spain and Italy all of a sudden are shut out of the financial markets.
I see. And Dr Frank, what has led up to Greece being in this situation?
Well, I may sound like a broken record because I always bring it back to money, but since the beginning of the euro, the ECB has followed a monetary policy where it gave out liquidity based on the highest quality assets, which were basically government bonds. So this induced banks to purchase government bonds, which reduce interest rates, and which induced governments basically to issue government bonds, to issue an excessive amount of government bonds, which led to an excessive amount of liquidity, which led to the housing bubble in Spain, in Ireland, in Cyprus, and to the sovereign debt crisis we're in today. So again, just like in the United States, we can lay the blame primarily on the monetary policy that was followed by the ECB since the inception of the euro. Now, essentially what happened between 2000 and 2009 is that Greece went on a government spending orgy. As we can see here, that the public sector wage bill in Greece was growing at a much faster rate than the public wage bill in the rest of Europe. Essentially, 45% of the increase in public spending between 2000 and 2009 was essentially because of the increase in the public sector wage bill. Now, Greece has been in a depression basically since 2010 with basically no end in sight, and that's been due primarily because it's forced the private sector to pay for what was essentially a public sector binge. Now, the EC is reviewing a report today where they basically talk about the fact that Greece has been able to reduce its wage bill. They talk about the fact that public sector wages have dropped 20% in November 2011. But if we look at this graph, which actually comes from this report, we can see that even today, the public sector wage bill is still excessive relative to the public sector wage bill in other European countries. The public sector wage bill will not reach the average of the other EU countries before 2014.
So, Dr Frank, what do you see moving forward from this?
Well, the current Greek government has imposed additional austerity measures to be able to get additional money from the EU. However, these austerity measures continue to require the private sector to continue to bear the brunt of the adjustment. For example, they are requiring the self-employed to pay a 26% tax. You have to understand that 30% of the workforce are self-employed in Greece, and half of those make less than 5,000 euros. Now, before they paid nothing in taxes. Now they'll have to pay 1,300 in taxes. So you can imagine this is going to create significant social unrest in the spring when these measures are implemented. This is why I think that ultimately the Radical Left Party will be the new government in Greece next year, and they're likely to default on their debt.
Well, Dr. Frank, thank you once again for coming in and sharing your insights with us today.
You're welcome.
That's all from this episode of Hollenbeck Unleashed. Just click back to the website for more interviews and updates.